What's up, everybody? Welcome back to Earn It, Save It, Invest It. I'm going to show you 4 stocks that are giving you a once-in-a-generation opportunity to buy. I'm going to go over the financials, I'm going to go over the charts, and I'm going to explain exactly why I believe these stocks could give you potentially massive returns over the next few years. So if you can, please give a like and subscribe. I'm going to try to make this as quick as possible because I am going to go over a lot. So the first one I have here is Adobe. Adobe, and this is not in any order, it's actually just alphabetical. It is down 53% in 720 days. It is also has performed 0% in the last 6.5 years. That's right. If you bought this stock 6.5 years ago, you made no money off it. The stock has been horrible, but the business has been great. You can have a stock fall over feelings and sentiment and not over fundamentals. So we're going to go over the numbers and the fundamentals in Adobe and exactly what they're about. My second one is Nike. I did put out a video about selling Nike, that I sold my Nike, but it was only because I had already had a very heavily weighted position on it and I wanted to spread that money out a little bit. Nonetheless, I think I actually put it out right before it had a big drop, and then it kind of went back up. Nike is though down 66% in the last 1,500 days. So if you bought this thing in 2021, you have made no money basically, right? In the last 10 years, this is the biggest one. 10 years, you could have bought Nike in October of 2015 and made no money. You would have made no money. That's insane. This is the year my daughter was born. If I would have bought stock when she was born in April of 2015, I would have made barely any money on this. That's pretty insane. But 0% in the last 10 years. Now, Nike has gone through a little bit more of a fundamental process and change, why it did a big decline. It went down, it had a new CEO who wanted to do a new strategy. Now they've gone back to, not the old CEO, but this guy is Larry Ellison. He's been part of the company for a very long time. So he's going to be able to run the company a lot better. And so again, Nike has been down 66%, 1,500 days, 0% in the last 10 years. So Nike could, if it performs, because you look at Nike, over time has performed very well. This is the worst stretch it has ever had. It's never had a worse stretch than this. Even from here, from 1996 to 2003, it still wasn't as bad, right? That was about an 8-year period. Of course, that was the dot-com crash, right? The dot-com bubble and all that stuff. So, but this is horrible. This is horrible performance. So Nike has a lot of potential to make some gains as well. Okta, if you don't know what Okta is, it's a cybersecurity essentially, right? 0% over the last 7 years, and it's down 70% in 5 years. 5 years, down 70%. Now this is, as you can see, this is March 2020. Oh, it went up all the way through the COVID diet, and then right in 2022 started to drop. You will see a lot of stocks that have that had that big pop up in 2020 to 2021. Even Nike, right? Nike has that, right? Here's 2020 into 2021, and then 2022 comes down and it fell down. Nike just it just went even further back, obviously, right? Okta, same thing. The COVID phenomenon essentially brought it up and then brought the stock price way up. All the PEs, everything was insane. Then it brought it back kind of down to reality in a way. But the business has grown. The numbers have grown. Things have gotten better with Okta. The business has gotten better in the last 7 years. They make a lot more money than they did 7 years ago, and yet the stock is exactly where it was 7 years ago. Trade Desk. Same type of scenario, except the boom again started in 2020, continued to go all the way to 2021. Then it kind of staved off for 2022. Then in 2023, it just had a big boom all the way for the next 2 years, 2023 and 2024. So for the last year and about a year and a third, right? So the 420 days, it's down 78%. 78%. The Trade Desk is down. And it's 0% in the last 5.5 years. So these 4 stocks have really done nothing. And again, the Trade Desk, doing well, right? It does well. The fundamentals haven't changed. The performance hasn't changed. Some of these things are, most of these stocks are based on like some fear, right? Adobe is more of a fear-based of AI. It's not based on their performance and not based on their numbers. As you can see right here, they beat. They're beating their earnings. Nike, that had to do a lot with the old CEO and the way that they're doing their inventory and how they went to digital first, and they, messed up relationships with the retailers and stuff like that, right? Okta, this is more about a financial situation that I'm going to go over. The revenue growth rate is not going as fast as the previous years, and that's probably giving concerns to investors. The thing is, they're continuing to grow their revenue, they're continuing to grow their earnings per share by a decent rate. So I do think that that's what's kind of holding Okta back right now. The trade desk, there's a lot of fears over Amazon and Google and them and the advertisement business, but the trade desk still holds a real good footprint in the industry. They have a lot of business, and again, their numbers have continued to go up. Their business continues to do well, even through 2022. Not one time did the revenue go down. So I'm going to now go actually through the numbers. So here we have Adobe, right? Over the last 1 year, 34% down. The PE, the forward PE is at 12.5. 12.5. That's pretty good. That's pretty good. As you can see, we have a buy, sell, strong buy, right? A lot of buys. If we look at their seasonality, we see here, we are in January. So February, not the greatest over the last 10 years, about 50%. They kind of are a half and half, 50% throughout the year. September's their worst month with 20%. July and November being their best months at 80% of gains. But this is just seasonality. I don't really care about that. Again, revenue, look at that, keeps going up. Earnings per share continues to go up. Look at the profitability, right? The profitability, the gross profit margin is almost at 90%. Their net income margin is at 30%. I mean, that's amazing, right? Let's go over their financials really quickly, because again, I don't want this to be too long of a video, but yet I still want to break down exactly why these stocks present a lot of opportunity. You look at the revenue, it's continued to grow throughout time, right? This revenue has continued to grow throughout time. Since 2019, it used to be at 11 billion, now we're at 23 billion, right? It has continued to grow and grow and grow. The operating income continuing to grow and grow and grow. The net income, which is kind of like, this is what you really want to look at, how much is like the profit? Well, continuing to grow. Now, granted, from here they went from 52 to 48 to 47, but ever since then they've continued to grow, and rapidly, right? These right here, what is this, 24? Yeah, 24 into 25. That was almost a 50%, like a 40% increase in net income right there. So financials look good right there. The revenue, the incomes look good. Let's see their balance sheet, right? How much do they have in cash and equivalents? They have $5.4 billion. And in total assets, they have $29 billion in assets. Total current liabilities is $17 billion. So they have about $11 billion in equity compared to the assets and liabilities. Pretty good. See their cash flow. Cash from operations, 10 billion. Cash from investing, 1 point, blah, 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 blah. Cash from financing, net change in cash. Now, this is something, obviously, that we can look at, the change in cash, right? But you look at why. Look at what's happening. What are they doing? Well, I mean, the cash from financing, they're wrecking it because they're repurchasing their stock like crazy. They spend $11 billion repurchasing stock. So that's just going to help out the investors, right? That's going to help out the earnings per share. So that's fine. Net change in cash, that's fine because they're just buying back their stock. That's what that mostly is. So I'm fine with that. That's really quick. This is Adobe. Let's go over their earnings. Now the earnings estimate, what annual EPS estimate, they only have to 2027, which is weird. I'm going to go over their earnings history. Let's see if I can break this even closer. Do you see any misses? I want to see, do you see any misses? Is there any red? Not one red. They beat. Earnings per share is going, look at this, 1, 2, 3, this is, they went from 481 to 550. Oh, it's not the biggest jump in the world, but you know, it's a 10% year over year. Now I get it. It may not be the sexiest, right? The sexiest, like how they were back here when they were doing 20% a year, right? In 2021, where everyone was doing stuff online and, you know, the COVID, everyone was making content and stuff. So everyone was buying their subscriptions and subscribing to them. And I'm sure, you know, the growth rates went down a little bit, right? Now they went back into the teens, right? Into the low double digits. But I mean, you look at it from August 2023, it's just been a consistent 10%, 11% revenue growth, right? The earnings per share is just growing and growing and growing. So Adobe to me seems like everything is fine, right? In the business in terms of the money, the financials look good. The thing about Adobe is the fear of like, oh, like Canva and all these other things that are going to do AI and AI videos, right? But you're editing videos, producing the videos, doing all these things. It's still so much more than just putting in a prompt. You have to put them together, and as much as AI can do some things, I have a feeling Adobe is going to be the leader in that. They're going to be the ones that if you want to edit something with AI, you're going to go to Adobe. You want to edit a photo, you're going to go to Adobe. Eventually, they're going to be the ones that hold it. So right now, it's more of sentiment. People are fearful that AI, they haven't captured AI yet. But when you look, their revenue growth is growing just as fast almost as their PE. Their PE is 12.5. And they're growing their revenue at 10 to 11%. So that's Adobe. Nike over the last year, 21% down. Its PE 39, so it's not low, right? The PE is not low, but they also had a lot of financial stuff. Now Nike's financials are going to be a little bit worse because they had to deal with tariffs, they deal with physical product, right? And they're kind of, you know, doing a rebuild in a way, right? They're having to reset a little bit, so it's a little bit different. But we all know what Nike is. Everyone has heard of Nike. We all know what Nike is. I didn't even thought I had it on this. But yeah, if you look at the PE, 39, right? Nike, we all know what Nike is. You know, like it's cutting jobs, trying to do automation. The world's strongest brands in 2025 ranked. Let's see where Nike is. Boom. Nike's up there. So when you see that, you know, Nike is one of the top companies that, you know, global brand power in 2025 remained concentrated among companies that combine scale with everyday relevance. YouGov's latest global survey shows technology still dominates, but consumer staples and autos continue to signal trust and durability. Here are the top 10 brands. So you have WhatsApp, Samsung, YouTube, Google, Adidas, Nike, Netflix, I've never heard of that one, Colgate, and Toyota. Nike's up there, right? You've heard of Nike, you know what Nike is. It's just, again, look, you look at these, right? Hold, sell. Just because it's down, what was it? Is that Nike? No, let me see Nike. Let me get to Nike. Just because it is down 66% in the last 1,500 days does not mean it can't continue to go. It can definitely still continue to fall. As you can see over the last 10 years, well, it hasn't been very good. November is its best at 90%, but other than that, everything is at 50% or lower, basically, except for June and July, right? So you can basically assume that over these next few months, it might be statistically a little bit harder, or historically, it looks like it might be harder to get some gains out of this stock. Here you can see, right, some of the earnings went down, right? Because again, they're kind of having to restructure how they do things. The profitability, its gross profit margin is at 41, the net income is at 5, which, it does sell products, has to deal with a lot of moving of product and making of the product. So, there's that. It does have a dividend. It is a dividend payer, right? Right now it's at 2.65%. So that's okay. Dividend growth history continues to grow, which is obviously great. Let's just go over Nike's numbers really quickly. So if we look at their revenues, right, and as you can see right here, they were continuing to grow, and then over here, it staved off. It actually went down. They're having to discount. They're doing, They're doing a lot of discounting with their products and stuff. They're having to get rid of a lot of inventory. Their business model changed a little bit, and so they're having to kind of go through this restructuring. But as you can see, this was in 2025, May 2025, but over the last trailing 12 months, it's gone up a little bit on the revenue. So we'll see. The next few earnings for Nike are going to be a make or break for the stock, for sure. The net income, the trailing 12 months is down compared, and it's continued to go down, right? Which, again, that's hurtful for investors, and it's hurtful for the stock. But they're in a turnaround phase. They are in a I cannot voice that enough. They're in a turnaround phase right now. They have $6.9 billion in cash and cash equivalents. Total assets, they have $37 billion. Total liabilities, $23 billion. So they have about $14 billion in equity. And then cash flow, let's see, cash from operations, $3 billion. Cash from investing, it's gone down a little bit, that's fine. Cash from financing, net change in cash. So as you can see, they've gone down in cash a little bit. They obviously pay a lot of dividends. They have actually been putting out some stock. They've been repurchasing more stock than they put out there, obviously. They've been buying a lot of stock back. Then they paid back some debt and stuff like that. So their net change in cash isn't great, obviously, but again, they're going through a restructuring phase right now. So that's, let me go over the earnings really quick. They have a little while for their earnings to come out. So as you can see over here, I'm gonna zoom in, let's go full screen. This is their revenue, this is their earnings per share, and then this is their revenue year over year. As you can see, November 2025 right here. And the year over year, right? When you look at the year over year, the revenues, it's not great, right? When you're looking at the quarters, it's not great. Now back here, it was a little bit better. It was a lot better. But then you go over here in the recent ones, they're not doing good. They're having to discount a lot of inventory. They got to get rid of a lot of stuff. But you have to imagine this. Imagine this. When this turns around, all this negative number, when all of those turn around back positive, the stock might rocket ship. When investors and Wall Street feels like, hey, Nike now has a hold of their business again, it's going to shoot up because they're going to start seeing, okay, this company can now start running efficiently and running back to the old ways. But it just hasn't been. So that's Nike. Now it's Okta time. Let's go to Okta. Its PE is 24, so it's about, in market range right now. We got some buy, some holds, some of that. Seasonality over the last 10 years. It's kind of up and down. December is its best month at 77%. January is at 75%. The next few months might, it's kind of a mixed bag. Really, I don't really care about the seasonality. I care about this. I'm looking at the revenue continuing to go up. Earnings per share. They're estimating this year to go down a little bit, but continuing to grow. Profitability, Gross profit margin, 77%. The net income is at 6%. So, and does not pay a dividend. So that's that right really quick, but I want to break down the numbers a little bit more deeper than that. Let's look at their revenues. Their revenues are continuing to grow. I mean, really, like you talk about 2020, 586 million, then 835 million in 2021. Now you're at 1.3 billion, 1.8 billion, 2.2 billion, 2.6 billion. Now in the trailing 12 months, 2.8. It's continuing to grow. The business is continuing to grow. Operating income is now, it's in the profits, right? It started to lose a little bit more money right here due to SG&A, but as you can see, SG&A was this selling, general, and admin expenses, 1.4 billion, and then it was even 1.4 billion still here in 2024, 1.486, now we're at 1.413. So they've staved off the SG&A, that's helped a lot. And so now now operating income is in the black. It's doing great. So the net income, now they are turning a profit, right? They are now turning a profit for their earnings per share, right? You can see the basic earnings per share, diluted earnings per share, right? It was always negative. They were not profitable until recently. And look at that. They're continuing to really get that number up. The balance sheet for Okta. Total cash is 645 million. Total assets is 9.2 billion. And the total liabilities is 2.3 billion. So obviously they have more assets and liabilities. They have 6.8, almost 6.9 billion in equity. So that's obviously good. They have a good balance sheet. Cash flow. Let's go through this. Cash from operations, 912 million, and again, continuing to just grow and grow and grow. Let me blow this up a little bit. There we go. That's better. Yeah, continuing to grow, right? As you can see, it's continuing to be profitable in cash from operations, cash from investing, and then cash from financing. And where's our net change in cash is 333 million. But as you can see, they are also now repurchasing their stock, and they repaid debt, right? So that definitely played an effect on their cash. And even at that, they still had the most cash that they've had that I can see in the last 5-6 years. So that's good, right? They're buying back. Wait, right? Yeah, where is it? They're repurchasing, and they're not issuing any stock. In the last 2 years, they've been buying a little bit heavier. So that's good. Now let's go over their earnings really quick. And this is what I was talking about. Okta needs to, this is where Okta is running into a problem, is that you see their growth rates February 2021, right, or just in 2021 in general, is that it went from 40 to 60%, 65% in the middle of 2022. And then after that, it went 43, 37, 24, 20. I mean, it continued to just drop and drop and drop. Now, the revenue continued to grow. The revenue is growing, and they haven't missed. Look at this. They haven't missed. They announce it, and they beat every single time. They're beating it every single time. But the growth rate is going down so significantly. To go from a 65% growth rate to a 12%, 11%, and investors are seeing it continue to go down and go down. Who's to say that next year this isn't 8%, right? Who's to say that it's not 8%? It could easily be 8% next year, but we don't know that. So the earnings for Okta are going to be really important, and for them to try to at least keep a 12% year-over-year growth rate with the revenue. Again, the earnings per share is continuing to grow, right? The earnings per share is continuing to grow at a good rate, but we'd like to see it grow at a faster rate. It was at 72 cents July of 2024 and just 82 cents October 2025. I guess that's, October 2024 is 67 cents, and then you go to 82 the next year. So that's good. So the earnings per share is growing. It seems faster than the revenue, of course, but I think that's what's holding back the stock in terms of investors, is them really seeing these numbers go down and down and down, right? So that's what's really holding Okta back. The trade desk, this is the last one. 1 year, well, what am I at right now too? 25 minutes, all right. 1 year, 74%, and PE is 17, right? The PE is at 17, let me put it right here, 17. It has a short interest of about 10%, but let's go over it really quick. Back it up a little bit. All right, buy, and it has a mix, right? It has a mix of buy, hold, seasonality, mixed bag all over the place. February is actually a really good month for it, so that could be actually good. Let's go through really quick. Look at this. Look at the revenue. Look at that revenue. That revenue looks great. Earnings per share kind of spotty, right? Kind of went down right here, and then should continue to be going up. Earnings estimate growth, great. Profitability, 78% gross, 15% net. The growth of revenue is 20% year over year. The CAGR revenue 3 is 23%. Doesn't give any dividends. Let's quickly go over the financials. Revenues, again, continuing to grow, right? You have 600, let's zoom in on this thing. Let's go full screen. You have 661 here in 2019, and now they make 2.7 billion in the trailing 12 months. The gross profit has continued to go up and up and up every single year. Operating income, same thing, going up every single year. Actually, from 2022. Net income. This is the most important number, really. This is what is passed on to shareholders. They obviously had a little bit of a struggle. This is 19, 20, 21, 22, and then they continued to, now the net income is continuing to just grow and grow and grow, and it never went negative. So I like that. The diluted earnings per share, it's just continuing to grow again since they had this year. What year is that? 2022, right? 2022 was a bad year in terms of their financials. Balance sheet, total cash and equivalents, they have 653 million, which is actually down. So we can go over exactly what they're doing with that. Their total assets is 5.9 billion. Total liabilities is 3.3 billion. So they have 2.6 billion in equity. Let's see. Oh, this is their balance. So let's see what they were doing with all that cash. All right. So we have cash from operations, 880 million, which again, that's growing. Cash from investing, CapEx, of course, and then investments in marketable and equity securities. This is it right here. Look at this. They are buying back their stock like no other. They are ripping through their cash to buy back their stock. I think that's a good idea. I'm buying their stock too. I think it's going to grow. They're buying back their stock. I like it. The net change in cash is negative 568, but that again is because they are buying back their stock very aggressively right now. It's going to help the EPS so much. So I love it. So I'm going to go to the earnings really quick. This month, they're the next one I think to actually post their earnings. It's going to be later this month. Earnings per share estimates is to go up. This is what I like to look at, the earnings history. Now, they have had 2 misses, 1, 2, since 2020. But I want you to see these rates. These growth rates are great. Now, they might have a similar thing to Okta, right? You have 48, 100, you got those 30s, the 40s, right? Now you're kind of hitting some 20s, and now you just hit some teens. Now, it's going to happen when you go from making 300 million to 700 million Like, your growth rate is gonna slow down. That's what happens. Like, every big growth company, that's gonna happen. But investors don't like to see that. Stock market doesn't like to see that. They missed on 1 earnings per share this whole time. Like I said, they missed twice on the revenue, but not that much. And they are continuing to grow. The earnings per share is continuing to grow. And also, one last thing that I think about this is that it is an election year. It's a midterm year. I do believe the trade desk is going to gain off that, right? They're going to benefit off an election year. A lot of advertisements are going to go out there. I don't believe the Amazon threat is as crazy, because Amazon likes to promote a lot of their own stuff. It's not as much of an open market, right? The trade desk deals a lot with like just the open internet and just all kinds of businesses and markets, where Amazon does a lot of their own stuff. Google, they do a lot of their own stuff, as well as other people. But the trade desk is kind of the leader in dealing with the open internet and with all the other companies. So that being said, that's all I really have. I'm going to kind of show you just quickly again these stock charts. Adobe, 0% in 6.5 years, down 53% in 720 days. Nike, 0% in 10 years, down 66% in 1,500 days. Okta, 0% in 7 years, down 70% in 5 years. And the trade desk is 0% in 5.5 years, down 78% in just over a year, about 420 days, about a year and 2 months. So that's just my opinion. I do believe these stocks are giving you, in a sense, a once in a generational opportunity to buy. You haven't seen these prices in 5 to 10 years. They are continuing to grow. I know the growth rates aren't spectacular on some of them, but depending on what it is, like Nike, they're going through a whole business change, right? Where the trade desk is just continuing to put out numbers. Okta's continuing to put out numbers. It's just not as big of a growth rate as Wall Street would like. So I do believe that these stocks, if all they do is hold on to their revenue, they show any kind of consistent revenue growth, or just not, having those revenues go down at all, and the revenue growth doesn't go down. They could just stay at 12%. They could just stay whatever percent they're at. I think that'll help the stock tremendously. That's for the trade desk and Okta. Nike, again, it's a turnaround story. Eventually, investors, everyone's going to believe in the stock. The business is going to turn around. The numbers will be there. And then Adobe, I believe it's more sentiment. AI fears of people not using it and this and that, when people are using it. The numbers show that people are using Adobe. So it's just my 2 cents. Thank you for watching. If you are still watching, we're at 33 minutes. I appreciate anybody who stuck through this. I really do. Thank you for watching. And never forget to earn it, save it, invest it, buy low, sell high. I want assets, not liabilities, and you can count on compounded interest.